right, so my title was supposed to be Permian Reserves, maybe much smaller than you think, but I think I gave that to the bulletin 45 days ago, so I just tacked on something to make it more fun, which is tight oil and the long-term debt cycle, which is actually more interesting to me than Permian Reserves at this time. But so we've got a bunch of real interesting guys in Washington these days, and of course our very own Rick Perry is now showing what he knows about energy in the same way he showed us what he knew about governance. And he tells us that we are entering a new age of energy dominance, American energy dominance. And that's well, I guess that's what I would expect him to say. And then his boss, he's got such a way with words. We've got underneath us more oil than anybody, and nobody knew it until 5 years ago. Wow. I'm not sure I could construct that sentence if I had to, but I think we know what he means. What he and Rick Perry are talking about is tight oil. And if you're talking about tight oil today, then you must be talking about the Permian Basin. And that's right there is a huge insight, because it wasn't, I think, the last time I spoke at HGS, which was a mere year ago, that we were talking about 3 plays, at least, maybe 4. And now we're down to 1. So we're getting bigger by doing less. Down to 1 play instead of 4, but we're going to dominate the world. Well, we'll see about that. My take on, well, and I can talk about politics, and it wouldn't be any different, but since we're talking about energy tonight, these statements, I'm going to be generous, they lie somewhere between aspirational and absurd. We might wish them to happen, which is aspirational. If we look at any data, we're going to find that they're absurd. So the country that is going to dominate world energy so far in 2017 has imported 9 million barrels of crude oil a day. I mean, that's more crude oil than continents use that we're importing, but we're somehow dominating. And our net imports of crude, because we are exporting a bit now, are 7 million barrels. So, you know, kind of hard for me to really understand how you dominate when you use more oil and have to import it than most anyone else. Well, this chart up here, I knew we couldn't see it very well. You don't need to. The red is us. The red's the United States. And the much longer blue lines above us are the really big producers, and then the smaller blue lines below us are the smaller. And it turns out that the United States is number 10 as a reserve holder, proved reserves in the world. And that puts us right between Libya and Nigeria, which is not the worst place to be, but hardly in the same class as Venezuela, Saudi Arabia, Canada, etc., all the truly top-tier reserve holders and producers in the world. And if you take that whole group of people that are above us and average their reserves out, they all have about 4 times more than we do. So I guess one of the beautiful things about being a politician is that you're not really confined by facts. So the only way I can possibly understand this, except that somebody told them to say this, is that maybe they read my favorite person, John Malden. And John Malden is a really smart guy. He's an economist. I actually subscribe to his newsletter because as long as he talks about stuff that he knows about, he's worth reading. But when it comes to energy, the guy's a disaster. In fact, he's an energy amateur masquerading as an energy expert. And he published something not very long ago called Shale Oil, Another Layer of U.S. Power. And in this august document, he shows the graph on the left, which says recoverable oil reserves, and numero uno at the top there is the United States of America. Now, either the graphs that I just showed you, which come from BP, EIA, IDA, etc., Exxon, whatever, are wrong, or John Malden is wrong. So the U.S. has more reserves than Russia. Saudi Arabia is third. And look at Venezuela. They're way down the list. Well, so you can't see this either, but he tells you that his source is Rystad Energy. So I went to Rystad Energy, and the graph on the right is actually what Rystad Energy published, and the title is Recoverable Resource Estimates. Okay, so there's, unfortunately, and again, politicians, you know, if it starts with RES, it's the same. And you know, whether it's resources or reserves. But, so what I learned was that aside from the title of this graph being wrong, there's so much wrong with it that I can't even explain it to you. I mean, I can't fathom how the man created this graph from looking at the same source that I did. And if you actually plot up Rystad's data, which I show there, you find that not only did he misrepresent the RES word, but he didn't even show their data correctly. And so top of the list of recoverable resources is Saudi Arabia, which I guess shouldn't surprise anybody in this room. The fact that the United States is second is kind of interesting, but again, you know, we're talking about two different things here. And I guess the question that I would ask at this point is, I mean, does anybody really care about recoverable resources anymore? I mean, that was sort of an interesting topic 10 years ago when we didn't really know anything about shale gas, and we were just discovering that there might be some really big amount of volume of gas out there, and we were kind of scratching around, we were guessing, we were having to use recoverable resources as a proxy for reserves. But I mean, at this point, we got 50,000 wells. You can do a reserve estimate. You don't need to do a resource estimate. So I don't really understand what these things mean, and since they don't have anything whatsoever to do with economics, in a $50 per barrel world, I mean, do we really care if it's technically there? I mean, you know, we can't even afford to produce what's known. So that's kind of what I think about that. But if we then ask the more practical question, which is the title of my talk, and I guess where some of you came, is what exactly is the growth potential of the Permian Basin? And that's the question that I think everybody wants to know. And so I'm showing a table here that comes from the EIA, and it is their estimate of proved reserves from all the various tight oil plays in the United States. And what we see here is, well, the Permian, for example, Pioneer's CEO Scott Sheffield, he says Permian production may exceed 160 billion barrels of oil. That's a pretty big number. That's what one person thinks. Even credible sources, which tells you what I think about Scott Sheffield, even credible sources like Wood Mackenzie have published information, charts that say that the Wolfcamp alone may add an additional 3 million barrels a day by 2024. And considering that the tight oil plays don't yet produce 2 million barrels a day in the Permian Basin, that's a huge chunk. The EIA, if you go look at whatever they call Permian, they got a really small number up there. 782 million barrels is the proved reserve number that the EIA had. This is as of year-end 2015. And you can look at the Williston, which is the Bakken, that's a little over 5 billion. What they call Western Gulf or Eagle Ford is 4.3 billion. And I think most people who know anything about those plays would agree those are probably reasonable numbers. The 782 always seemed low to me. And so I thought, well, I'm going to do what EIA does. EIA goes into the 10K annual report SEC filings that public companies are required to submit every year, and they go in and take a sample of the biggest producers, and they say, okay, what are your stated proved reserves? And then they figure out a way to somehow apply that to a broader sampling. So I did it. And shown here are all the producers, the largest producers of tight oil in the Permian Basin. Concho is number 1, and Pioneer is number 2, and you can read down the list. And all of the people, all the companies on this list specifically state what their Permian tight oil proved reserves are. And a few of them, it's a little bit more complicated. Pioneer doesn't tell you what's Permian and what's Eagle Ford, but you can figure it out pretty easily because they're basically only in 2 plays. So what I did is I took all of these guys and added them up, and what they stated their proved reserves were at the end of 2016 was 1.7 billion. And then I developed a formula, basically, that was tied to cumulative production to account for all the other big producers like Apache, like Oxy, that for one reason or another just don't tell you, how their Permian reserves fit in their global portfolio. So these companies that I used that told me they account for 47% of all the production of tight oil in the Permian Basin. I mentioned Apache, I mentioned Oxy, EOG, Anadarko are 2 other big producers that just hide the Permian, and they don't hide it, they don't have to tell you, so they don't tell you. And so I used that, and I came up with the number that you see there, which is 3.7 billion barrels. And quite honestly, that number didn't surprise me at all, although it probably surprises some people in this room. How is it possible that the Permian Basin proved reserves might actually be smaller than the Bakken and the Eagle Ford? And that's a really good question. But that's the number, and it's based on the people that ought to know. Certainly the people that, if they lied to the SEC, technically could go to jail for it. So I think there's probably, some truth to it. And then, so the next question is, well, okay, fine, Art. We'll accept your 3.7 because you're an extremist or a contrarian or whatever. That's not my interpretation. That's what they told me. But there's, what about the growth potential? I mean, the USGS just published some report not too long ago that came into the newspapers as a 20 billion barrel discovery, which would be pretty cool, except it was recoverable resources and hasn't been discovered yet, but people don't make that distinction. So what about the growth potential? Well, thankfully, I guess, there are 2 big producers out there, in fact the 2 biggest, Concho and Pioneer, that in their annual report tell you what they think their proved undeveloped reserve profile, production profile is going to look like over the next couple of years. Now mind you, PUDs are part of proved reserves, so this doesn't increase their proved reserves, but what I show here is that both of these large companies, and they're both Pioneers in gold and Conchos in blue, they're both telling you that their PUDs are going to peak in 2019. That doesn't sound like American energy dominance to me. Turns out their PUDs are only 25% of their combined daily production, so my contrarian view is good luck if that even offsets your decline of legacy production. So I've worked with a lot of engineers in my life and continue to and learn from them all the time. And engineers like to talk about tanks. And I can relate to a tank. As a geologist, that just has a beautiful simplicity to it that reservoirs never do. And again, hard to see here, but what I'm showing here is the Permian production in red. The Eagle Ford declined a lot in gold. Bakken declined a lot in blue. And so we look at these three plays. We see that the Permian is still climbing like crazy. The other plays have rolled over. What's the conclusion that the untrained eye would come to? Doesn't this mean that the Permian is just going to continue to increase? And very soon it will surpass the other two plays, and therefore it's just going to keep on going. Well, this is where the tank theory comes in, because if the tank is smaller than the other two tanks, the fact that you're producing more today than the other two ever have means you're draining the tank sooner, but if there's no more to put in the tank, it's got to go down. Maybe I'm missing something there, but I like that logic. It's simpler. So what we're seeing here is, well, maybe seeing here, the Permian is the benefactor of all the horizontal drilling and hydraulic fracturing technology that was developed in the earlier plays. And so these guys have figured out how to kick ass. I mean, you want to accelerate production? We know how to do it. What does that tell you about the future trajectory of that production? Well, it doesn't tell you anything, but the size of the tank tells you a lot, I think. So you can drain the tank with the best technology at very high rates, but ultimate production is limited by the size of the tank. Concho's and Pioneer's future production forecast says peak production in the Permian could be a whole lot sooner than it is later. I don't know. Already, investors are getting upset because some of the key producers, in fact, two of them on my list, their gas production's going way up, and shareholders want to know what the heck, what's going on here, guys? Are these oil reservoirs going to turn to gas? And I would say, no, I don't think so, but that's what they're afraid of. So there are problems in paradise. Well, I did a little study a few months ago on the Bakken. I hadn't looked at the Bakken in a while and thought, well, it's time to look at the Bakken again. I guess I had nothing better to do on a weekend. My wife was out of town. My kids are all grown. So I went and looked at the Bakken. And what I found in the Bakken was surprising to me. And what I found was that, again, you'll get these slides, and I apologize for the poor projection here, but what people look at in the Bakken is they say, wow, the 3-month cumes are really high compared to just last year. The red is 2016, and you can see all the previous years below it. And they're saying, so productions, the EURs, the reserves are going to be much higher. Well, unfortunately, if you plot the data out just to where it ends, which is where that red circle is, those really, really high production rates have already crossed over the previous decline rates of the years before that they were much higher than. So you're getting a whole lot more out early, and it's declining a lot faster. Well, that was kind of surprising to me. So in other words, EUR is actually decreasing rather than increasing. So, rates can be confusing. But what I found that really started catching my attention is the second graph. And that is that this is showing gas-oil ratios. So the blue is 2012, the gold is 13, the green is 14, the black is 15, and the green and the red is 16. That's just gas-oil ratios. And what that's showing is that the percentage of gas is increasing with every year of new production. Huh, that's interesting. And then I started looking at water cuts, which is the graph on the far left, and what I found was that the water cut, the percentage of water relative to water plus oil, is also increasing. So I went and opened up my Schlumberger book, and I came across this very interesting diagram, which says, oh yeah, that's exactly what happens in solution gas drive reservoirs. That particularly in a tight oil, an unconventional kind of situation, you got no trap. You got no structure. You got no column. And so the only thing that you got that's pushing the oil up to the surface is the expansion of gas that's dissolved in the oil. That's your drive mechanism. That's the same as if you did have a structure, except with the structure you've got the buoyancy effect of a folded structure, a stratigraphic trap. You've got the buoyancy of a column of oil down dip. You don't have that in these tight oil plays. So what happens is that you start producing gas and oil, and the percentage of gas increases, and that's good because that's getting you more oil to the surface until the amount of gas starts declining. What's that say? That says that the energy in the reservoir is going away. And what's happening in the Bakken is that you're increasing water production, and that's exactly what the Schlumberger chart tells you. It says that as that gas expansion starts to decline, you get declining oil production, increasing GOR, then GOR decreases and increasing water cut. And that's what's happening in the Bakken. Now, nobody up there wants to admit it, but that's what's happening. These trends suggest that they suggest depletion, and that the play has already been over-drilled, that there are more wells drilled than you need to drain the tank. Well, that really is an impressive looking graphic. This is Pioneer's Permian Basin GOR that shareholders got so unhappy about. So this is just gas-oil ratio. That's November of 2016. Gas-oil ratios increased 28% from November. Look familiar? I don't know. To me, it's too early to say. But if you look at all the tight oil production in the Permian Basin, the water cut is 70%. 70%. And I got to tell you that, the Bone Spring and the Wolfcamp, we're talking about one well per 1,000 acres. Those plays have hardly been drilled to anything approaching optimum spacing. Sprayberry's a little bit different because that's an old play. But if you got 70% water cut on 1,000-acre spaced wells, I think you got a problem. I would love to have a problem with 1,000 barrels a day, but they're not giving it to me. So what I'm showing you in this study, here, by the way, here's the United States, and I think I've got BP is blue, EIA is gold. Okay, so in the scheme of all this, there's the Permian Basin. And I don't show it down there to diminish its significance, because it's very significant. But put it in its correct context. I think that was one of my opening comments tonight. We've got to put this in. And so if the Permian Basin is the sole basis for U.S. energy dominance, then we got a huge problem because of that graph. What I'm showing here, yeah, it's just a scenario, okay? It's based on one guy's attempt to put all this into some sort of a framework. But let's be honest. aside from weak growth in the offshore Gulf of Mexico, which mainly comes from projects that were sanctioned when oil was $100 a barrel, and every one of those companies wish they didn't do it because they're losing their asses today. But once you start, you can't stop, and there's a couple of 100,000 barrels a day in the deep water that's continuing to grow. That's the only growth outside of the Permian Basin in the whole United States that somehow is going to come together to make us the kick-ass, dominant superpower of the world in oil. How does that work exactly? It just doesn't make any sense to me. For the U.S. to move into the top tier of oil producing countries, our reserves have to at least double to get us into the Russia-Iraq kind of category. We're not going to be anywhere close to Canada, Saudi Arabia, Venezuela, ever. If I'm wrong, and let's just say that the Permian Basin reserves are 3.7 billion. Let's say they're double. Let's say they're triple. 2 times that, added on to that, doesn't get you that. No way. So what we're looking at in the Permian Basin, we're talking about the rabbit and the hare. It's amazing as I get older. I read fairy tales to my children. I was just in Denmark, and it turns out that Hans Christian Andersen was writing all these fairy tales about all the scumbags that lived around him on the wharfs in Copenhagen, which is a crappy place to live. He wasn't inventing these things out of some idyllic place in his mind. He was suffering, and he was trying to turn all these slime bags that were around him, ripping him off into demons and witches and all of that. And of course, he was the prince. But so when people tell me things that sound too good to be true, I find they often are. And similarly to this scenario, when somebody tells me that one basin that's been producing for 75 years is somehow now the saving grace of the United States of America, well, that sounds too good to be true too. Okay, so I'm done with the Permian Basin, except to put it in the much larger context. And that context is the long-term debt cycle that the world, but certainly the United States, is now in. And so this is one of those graphs that is probably better contemplated over a glass of wine or something than in a room like this. But what I'm showing here are oil prices in blue. These are shown in 2016 dollars, all of them, so they're all adjusted. The graph goes from 1960 to 2016. I'm showing debt in red and U.S. GDP in blue. So what happened was, back here when oil was $23 a barrel, after World War II, the global economy went through unprecedented economic growth because they all followed the United States in becoming a petroleum-powered economy. Most of these countries, England and France and Germany, they went into World War II running their economies on coal, which is pretty good. But, a barrel of oil, depending on how you convert it to kilowatt hours and all that stuff, it's got something between 7 and 11 years of human manual labor, all packed into 42 gallons of stuff that you can carry around with you. You can pour it in your car, you can put it in an airplane. And if you don't think that there was good reason for the unbelievable expansion of human progress and economic well-being when you took, what a human being a couple of hundred years ago took him 11 years to do, and you put it in a barrel, it even costs $100 a barrel. It's a hell of a good deal. That just totally transformed the world. And we got used to it. We got used to living on $23 a barrel until 1974. And that changed everything. Everything. Because all of a sudden, this thing that was so wonderful was no longer cheap. I mean, in 1 year, in 1 month, the price doubled. The real price, today's price. And we had this big thing, this huge bubble that was created in the oil business because of high prices. So the oil shocks of 74 to 86 threatened to end that petroleum age party. We had, this is demand, positive, negative. There's the big bounce in oil prices. Big time demand destruction following that spike because people couldn't afford to pay the equivalent of $100 a barrel when they were used to 23. Demand destruction and the unbelievable amount of production that was brought on in places like Mexico, the North Sea, Siberia, China, because oil was worth a ton. Everybody was piling in there, spending big bucks on petroleum exploration. We found so much oil we didn't know what to do with it, and we got almost 20 years of pits right here. The average price is $34. And most of us who are in this room were old enough to remember that life was almost as hard then as it is right now, for almost exactly the same reasons, a little bit different. Well, we had a friend who is now the mythological idol of the North American, the U.S. right wing, Ronald Reagan. And Ronald Reagan discovered something really wonderful, and it was called debt. And we revere Ronald Reagan for getting us off of center. Our economy was a mess in the 1970s. We had inflation. Cities were going out of business. And Ronnie fixed all that by getting us into debt. And we love him for it because that's our way of life. And so what happened is that after 1986, U.S. debt it crossed over GDP and is forever growing, much greater than GDP. And people want to know, why can't we get back to growth? Well, as everybody in this room knows, if you owe a bunch of money, you have to take all the money you make and give it to somebody else, so it's really hard to grow. Well, we'll skip to the meat of the story, but basically what happened was we had a second oil shock right before the financial collapse, and that was the result of debt-fueled growth in China. And after this shock was over and the world collapsed in 2008, we entered into a period we still have of zero interest rates, or effectively zero interest rates. And everybody piled into oil again because we got to do something with our money. And it's interesting, too, that with this giant price spike, we never had any demand destruction. Had it every other time, and the reason we didn't have it was, as I've told this group before, it's Ford Truck Month. It's zero interest rates. We will find a way for you to afford whatever it is you need if we just give you enough time to pay for it. You don't have to pay for that truck. You don't have to make a payment for 5 years. You don't have to pay any interest for 7, and then you got a big balloon, but by then we'll all be dead, so it doesn't really matter. And that's the world we live in, okay? And so there's nothing wrong with it. It's just the way it is. But the point of all this is that we are now at the end of a long-term debt cycle, and yet most of us in this room, and certainly most politicians and economists, are claiming or believing that nothing's changed. Nothing has changed. And I get tomatoes thrown at me all the time because I happen to believe that oil prices matter and that peak oil is a problem, and this graph shows that it's a huge problem. Oil today, at $50 a barrel is still 2.5 times more expensive than it was during this period of great economic growth. That's a fact. I mean, people say, well, that's your theory. Well, facts aren't theories, guys. Low oil prices created a capital bubble for the Permian Basin. It's real interesting. Here's WTI. Here's all those zero interest rates. End of QE3 happened right exactly when oil prices collapsed. I'm not saying that one caused the other. It's just real interesting. That was the first time the Fed raised interest rates from 0.09% to 0.12. But the point of all of this is to say that when you got no interest, you can't make any money on CDs or money markets or treasury bonds, you need to go somewhere else. And there's a whole lot of money in the world that's always looking for a yield. And it can't find it in traditional ways. Where does it go? It went to its investment bankers. They pointed it to the U.S. tight oil business. And over time, that's shrunk down to the Permian Basin because you got to get a yield. You can't get by on 2%. You need 6%. You need 7%. You need 8%. Where are you going to find it? You're going to find it in high-yield junk bonds. You're going to find it in mezzanine loans. You're going to find it in preferred shares that pay you 8%. Share offerings. That's where you find it. And that's why all this money went to tight oil initially and is going to the Permian Basin today. $30 oil prices, which should have killed U.S. E&P, resulted in an absolute flood of capital. We're talking late 2015, early 16, to a select group of producers that were viewed by the investment community as winners. And now we got a president that likes to tell us who's a winner. Well, these are the winners. They got all the money. For those of you that were playing in other tight oil plays, even hard to get money. Not for these guys. An outfit like Parsley or an outfit like Concho, they open up a share offering, and 4 hours later they got $2 billion. Man, that's really good. So we go over here and we look at how this all worked, and so here's WTI at $30 a barrel. Rig counts are up above, a weekly change in rig count, and it turns out that Permian rig counts have more than doubled since August of 2016. Wow. Rig count means nothing more than where's the money. That's all it means. People want to make it into more than it is. People want to say it doesn't matter anymore because we got multi-pad drilling. The only thing I ever use it for is where is the capital going and how's it being spent? Because that's big bucks right there. Turns out that this increased rig count and fear of ongoing oversupply is probably the #1 drag on oil prices today. OPEC can't seem to do anything about it because these guys keep drilling wells. Got everybody spooked. OPEC's failure to quickly balance the oil. We believe Hans Christian Andersen. We really do. We believe that OPEC's going to come in just like in a Shakespearean play. They're going to lower them down on the stage. They're going to tell everybody how they're to resolve all their problems, and everything's going to be great. And in a matter of a couple of months, oil prices are going to be back at $100 a barrel, and it can't happen because of the previous slides. That world doesn't exist anymore. It stopped existing at the very latest in 2009, when OPEC did save oil prices a little bit. But what this graph also shows, real interesting, this is just Permian weekly rig count change versus WTI. And what you see is that as long as the market thinks that oil prices are going up towards 60 or higher, the rig count goes up. When they lose that faith, the rig count goes down. When they gain it again, the rig count goes up, and when they lose it, and right now it's going down. And so we can talk all day and all night about who's breaking even at $40 oil, or who's breaking even at $20 oil? Pioneer says, $20 oil, they can make money. Well, I don't think so, but what that's telling you is that on balance, and there are companies for sure that can break even at $40 or $50, but the play in general needs $55 or $60. That's what that chart's telling you right there. This is what my business partner calls voting with your feet, okay? You can show me all the economics in the world, but when the rig count starts going down, when people lose faith in $55 oil, that's telling you what the right number is for the play on average. Well, energy stocks have suffered in 2017. This is Vanguard. It's just an ETF of mostly oil and gas. They've been sliding since the beginning of 2017. Here are the two biggest producers in the Permian Basin, Concho and Pioneer. They've been kind of going down, but whoa, they both fell off a cliff here, like about 6 weeks ago, okay? That's when the market lost faith that oil prices were going back up. This shows flows of capital into U.S. E&P. 2014 is the big spike, 15, 16, 17, big negative, okay? Money's going away. Before I finish, I'm going to tell you, maybe not for the first time or the last, that if you want to understand oil prices, you need to talk about comparative inventory. Because everything you hear in the news about why oil prices went up or went down, it's all a bunch of crap. It's what a bunch of guys who don't have any background in oil and gas, what they dreamed up today was the reason, and maybe some of it's true. But comparative inventory is the thing that really controls oil and gas. And what I'm showing right here now is, on this graph, is I got inventory, how much oil's in storage in gold, and I'm showing the 5-year average in blue, and comparative inventory is just one minus the other, so you can kind of imagine a line that runs in between. And so here's the oil price collapse, and Lord, look at what happened to inventories. They went berserk, okay? So when that comparative inventory goes up, it's a perfect negative correlation, the price is going down. Works every time. And what's happened here recently is that comparative inventory has been going down for about 25 or 26 weeks. Every week, just about. Last week was an anomaly because of Harvey. But for the most part, we're drawing down inventories. And that's a real good thing. I mean, we need that to get oil prices up. But this is what you have to get into if you really want to understand where things are going. Comparative inventory's fallen over 100 million barrels over the last couple of years. But what this graph on the right shows, this is the same data. It's just comparative inventory versus price. And for those of you that do anything in the stock market or commodities, that's what's called a yield curve, okay? That's, at different comparative inventories, what kind of money can I make on that deal? Well, in February, we plotted over here with that blue dot. We've moved all the way over here. That's a huge distance to travel in comparative inventory, but we haven't seen oil prices go up, and that's because that yield curve is real flat. And it's real flat because you got such damn high inventories to start with that you got to go a long way before you make a difference. But the point is that the curvature, the rate of curvature in that line, we're just getting to the point where it's starting to get some actual movement in it. And so as we incrementally move farther to the left, that price is going to go up. And you can probably see from where you sit that the price of oil today is actually below the line. It's undervalued by a couple of dollars a barrel. You're hearing that from me, by the way, so it means a lot. I'm always negative, right? I'm being positive now. Write that down, those of you who are taking notes. But so what I did is I said, well, okay, I've played the game with the Permian Basin. Let's just do it with WTI. And so I came up with an estimate of where do I think this comparative inventory is going to end the year. And I did that, with a lot of hocus pocus. I looked at, EIA tells you what they think inventories are going to be every month, and I looked at the rates of decline and took a few guesses and wild stabs, and I came up with this range, okay? Somewhere between 40 and 75 million barrels. And the beauty of these kind of yield curves, and we all learned this in geophysics classes. If you know one number, you come to a curve and you read another number on the way over. So if you know the range of comparative inventories, you go up and read what WTI is, and it tells you that barring something that we don't know about, WTI is probably going to be between $50 and $56 a barrel by the end of the year. Now I said it, and I'm probably wrong, but that's what the yield curve tells me. If we continue drawing down at the rate we have, or a little bit less, that's where we end up. That's kind of cool to know. Closing thoughts. You got to have context to understand anything. We're mostly geologists in this room, a few geophysicists. We like analogs. I like analogs. I look at something, I don't know what the hell it is, and somebody says, hey, that looks kind of like, remember that thing we looked at a couple of years ago, and subsurface? Oh, yeah, and all of a sudden it kind of gets clear. I got a context. I got a look-alike. I know it's not the same exactly, but it's close. And so, we're looking again at Permian Basin, all the big reserve holders. Over here we're looking at a chart you don't see very many places, but it's actual supply-demand balance. Supply minus demand. I'll tell you how I made it sometime if you want to know. I got one that goes back to 1970. And what this all shows you is that if you want to know where the Permian Basin fits into the scheme of things, I'll tell you. Its reserves are relatively small, and this goes for tight oil as well, relatively small in this big context. I'll take every 100 million barrels you want to give me, or even a few million, but relatively small, and costs are relatively high. There's all kinds of BS that you hear every day. Like Scott Sheffield tells you that 160 billion barrels, but it isn't true. I mean, why is the guy not in jail? I don't know, but he's not. He's richer than I am. But what we've got here in this relatively small, relatively high cost set of plays is a just-in-time supply that has never existed in the history of oil. Make a big-ass discovery, and it takes you 5 years, it takes you 10 years, and a ton of money, and a ton of negative cash flow before you finally get all the partners on board and all the problems you got with Azerbaijan or whoever the production sharing agreement is with, and you finally start making money. Well, that's not the case with these tight oil plays. You go out there and you drill one well. You can get that well producing and online, in better times than now, in a couple of months. Now you got to wait a little longer for a frac crew, but it's a just-in-time kind of supply that's totally screwed up all of our traditional notions of how oil markets work. What I'm telling you is that we're dealing with a bunch of economic rules that nobody really is prepared to understand, at least not in my experience. And that's another set of tricks we got to deal with. The global leverage of these tight oil plays, you read the paper, you listen to Donald Trump, you listen to Rick Perry, and they're going to tell you this is the greatest damn thing that's ever happened. It's awesome. And I'm going to tell you it's the worst thing that's ever happened for those of us in the oil business. There's nothing about these plays that's anything but negative for the whole world. They've cratered the price of oil, the global price of oil, and nobody can do anything about it. OPEC can't do anything about it. There's nothing wrong with the plays. I love the plays. I'm just telling you, this is the reality. We're all hurting here because these guys can't keep their pants on. And you give them some money and they're going to drill another well, and the market's saying, holy crap, what are you doing, guys? We got too much oil already. And then you got Wall Street, and they say, give them more money. And I'm sitting there saying, The world is insane. The guys that are crying about low oil prices are creating low oil prices, and we're cheering them on, and yet we're all bitching to each other about how we got no work. I'm glad all I have to do is analyze this stuff. I mean, people want me to explain it, and I tell them my degree's in geology, not abnormal psychology. The key to the whole thing, key to the oil business has always been and will always be capital supply. It has nothing to do with break-even prices, doesn't have anything to do with reservoir quality, doesn't have to do with any of that stuff. That's what we do to play with ourselves at night in this room, because that's what we were trained to do. It all has to do with who will give me money today. And if you want to know whether oil production in the world is going to increase or decrease, just tell me how much money you're going to give me. If there's enough money, it'll go up. If there's not enough money, it'll go down. That's the way it works. And what I'm showing you is that this capital supply may not be as available going forward as it has been. Now, most of the forecasts you read, I don't care if it's, Citibank or, whoever, all these investment bankers that just out of the goodness of their hearts do all this expensive research as a public service. You might want to question why they do that, but they do it, and all of their forecasts assume business as usual. Everything's going to keep on going. And you look at Exxon's world production report. The economy keeps growing, maybe not 3%, maybe only at 2%, but it's growing, it's always growing. And what I've described to you is not business as usual. I'm showing you a global economy that's at the bitter end of a long-term debt cycle that it can't sustain. Okay, I'm not a conspiracy theorist, and I'm not an apocalyptic thinker. I'm just telling you that's a fact. And I don't know when that thing is going to collapse, but came pretty close a few years ago, and I hope it lasts long enough for me to die, but it may not. So, my take is it's unlikely that proven Permian reserves can deliver forecasted production. The only way that these production forecasts can live another day is if they find more reserves. They got to increase the size of the tank. They got to find new plays, or they got to find new pools. They got to do something, because you can't take nothing and make something out of it. You can't take 3.7 billion or 5 or whatever the right number is and save the world. Those who celebrate tight oil play innovation really need to consider the desirability of more years of depressed oil prices, because that's kind of what it gets you. So that's my take, and I'll be glad to take questions from you. Those are good questions and fair points. And so the position that I'm in is I have to make sense out of publicly available data. Some of it's pretty good and some of it stinks. It doesn't change the fact that I have to make sense out of it. So I got to plow through it one way or another. And of course, I'm painfully aware of everything you just said. But that's what we got. And that's why if we were having a much longer conversation than whatever length this talk has grown to by now, we'd be talking in terms of probabilistic ranges, because that's the way, and you mentioned a few of them, that's the right way to do it. I run the risk of putting people to sleep as it is without getting into those statistical details. But no, your points are excellent. I mean, we were just talking at dinner about how do you resolve multi-well lease reporting in places like the Permian Basin and the Eagle Ford Shale, and the answer is you can't, but you have to. I mean, somebody, whether they're John Public, who just expects the answer from me, so they can ridicule the fact that I'm wrong or whatever, or actually a paying client. It doesn't change it. I still have to come up with what I think is the right answer, and I'm going to tell you that these are all the uncertainties that go into it. And there's huge uncertainty, but the point, and I think what you're saying and what I'm saying we agree on, you're not going to get from whatever the right proved reserves of the United States are, 45 or 50 billion barrels, you're never going to get to Saudi Arabia's level, even if they're lying through their teeth about what those reserves are. You're not going to get to 200 and some odd billion. If you cut theirs in half and double ours, you're still not there. So those are the kind of, that's why I say that you're right. 3.7, that's the information available to me. That's 2016 10K.
But you stated that you have to increase the tank someplace.
Right.
Could it come from the probable possibles?
Sure, could, but so can everybody else's. So I mean, so the real question you're asking, and I can't really answer it, but is there some kind of a relative scaling point that we could talk about? And that's how I did the Permian. But is there a way I can scale Venezuela's proved reserves to the United States? No. But I just know when I make broad statements like we've got to have something like 3 or 4 times the reserves to get into the same tier as them, I think that's a fair statement. Anybody else?
It's a tough question in general.
Well, it's a good question. The simple answer is that ducks suck. That's the answer. Most of those ducks are crappy wells. They were wells that were drilled when anybody could get money. They were wells drilled in, Barnett wells in Palo Pinto County. They were those kind of, for anybody who knows the Barnett. I mean, you don't want to be there, but somebody was there because that was the least they could get. If they got somebody's money and they drilled a crappy well in Palo Pinto County. There's a whole bunch of those wells, and the reason that they remain ducks is they didn't make any sense at $100 oil, and they sure don't make any sense at $40 oil. And by the way, I think most people in this room understand that, that WTI is not the amount of money that you get at the wellhead. If you're out in the Permian Basin and WTI is $50, you might be getting 45. If you're in the Bakken, it's a whole lot worse. So the real question then is what amount of those ducks are actually a threat to supply? And the answer is I don't know. But I suspect, the people that have a choice, and some of them will talk to you about that, EOG or Continental, I don't know if I trust anybody, but they do try to speak plainly about what they're planning to do. And they will tell you that, we're going to complete so many wells and we're choosing not to complete them. Well, there are reasons for that. And it's my belief that we live in an industry of very greedy people. And that's going to drive them to spend their money on what gives them the most benefit personally, which is stock options and whatever that makes their company theoretically richer. So there's a selection process going on, and so there's a certain number of ducks. I'm going to just pull a number out of somewhere. There might be 15% of them that these companies really, really would like to get completed as soon as they can because they think they're good wells. And the rest of them, they already had a chance to complete them, and they chose not to. They chose to spend that money differently. And that tells you something right away. But the bottom line on ducks and a lot of these other subjects, the EIA just a couple of days ago, last week, it's kind of slipped it under the radar on us, but downward revision in June crude oil production by 220,000 barrels a day. Wow. where's all the growth? Well, because there's no frac crews. You can drill all the wells you want, but if you can't frac them and you can't complete them, you can't convert them into supply. And so with the DUCs, let's assume that half of them are really kick-ass wells and you really want to complete them. When do they get completed? When the queue gets to you. And so there's a time averaging that's going to go on there. All those barrels eventually will come on, presumably. But they're sure not going to come on all at once. And because we're greedy, we're going to complete our best wells first. We saw the same kind of fear in 2009, 2010 with shale gas. You know, the price of gas is going to go to, negative 50 cents. And it never happened. Now, this is a little bit different situation, but, I go back to Y2K. Woke up on January 1st, 2000, and ATMs worked. Nobody ever got sued over that. How many hundreds of billions of dollars were spent on fear of Y2K? Nobody ever talks about, the fact that we were duped, seemingly. Do DUCs fall into that category? I don't know. We got sort of a limited number of analogs to look at, but wouldn't shock me. I'll be wrong, as I said. Yes? So that gets back to my opinion about recoverable resources. And I've told you what my opinion of that is, and that is that I never had a very high opinion of those because they're irrespective of money, of economics. But particularly in a low price environment like we're in right now, I'm sure there's a study out there that, it's looked. The USGS does brilliant studies. It's just amazing to me how, I can't imagine. One of my clients wanted me to look at this weird show he had in Navarro, in East Texas. A couple, I said, okay. And damn, if the USGS doesn't have a report on undiscovered resource potential in the Taylor Navarro, awesome. I think their number's totally wrong, but they've done the work. So what I think you find in a basin like the Permian is it's just chock full of oil. That's why it's still kicking after 75 years. Frankly, I just couldn't believe that anybody was interested in the Permian Basin 10 years ago. I went out there to look at outcrops and all these cool turbidites and stuff, and I just couldn't imagine that there was very much more oil to squeeze out of that sorry old basin. Particularly in something like the Sprayberry. Old man Sprayberry, gosh, he sold that lease in 1946. As far as I know, nobody's ever made any money off the Sprayberry field, but maybe he did. So I think your point is well taken. But I don't know that I don't think it would really help calibrate that number, because what it's going to be calibrated against is going to be a huge number. Just an absolutely astonishingly huge number for the reasons that nobody's ever made money on the Sprayberry. You can't get it out. The in-place number is astronomical, which is why the Permian Basin it persists. But again, for me, I'm a one-man shop, and nobody pays me for most of this stuff. So I'd love to have the luxury of a staff of guys and say, go work on that. But so for me to go in and just look at all those 10Ks, that's a week's worth of work for sure. So I just take it at face value.
Okay. Second one was, do you find peak oil or peak demand arguments most compelling?
Okay, fair question. I get criticized all the time because I was director of the Association for the Study of Peak Oil, and I never was able to convince anybody that because I thought studying something was the same as supporting it, we were not the same. I like to study lots of things. peak demand, I've got a graph I'd love to show you that goes back to 1970 and looks at demand for however many years that's been, 47 years, and it's 1.3 million barrels a year like clockwork on average. And I think, like Winston Churchill's death, or Mark Twain, or whoever it was, the rumors of my death are premature. I don't know where this comes from. And, I mean, even Shell, who is has been one of the more vocal advocates of peak demand, just in the last week said, oh, well, we didn't mean before 2040. And I was just in Norway, and the guy who drove us from the airport to downtown was, one of the first things he wanted to know, I was in the energy business. He wanted me to know that there were more per capita Teslas in Norway than anywhere else in the world. It was just impressed the hell out of me. Gosh, that means you got a lot of money over here. You got rich people in Norway. But yeah, you go over to Europe and they're planning for the end of the petroleum age. I mean, it's right around the corner for those guys, and they're smart people. I think they're dead wrong. They also have the highest energy costs in the world as a result, and they also have super high social welfare costs, which most people in those countries think is pretty great. So they're just different. But peak oil, I think the concept is as understood, and I'll tell you how I understand it. And I know and love Colin Campbell and John Herrera and those guys who I think invented the modern understanding of the concept. It is the end of cheap oil. That's what peak oil is about. It's not about running out of oil. King Hubbard, he was a statistician kind of guy. He was a resource estimator, and he was the one who said, he got it right, but that you're looking at a kind of a mean regression kind of a deal. But where the idea ever came that that the peak is going to be in this year, I never gave a crap about that. What I can promise you, and all these graphs show, is we ran out of cheap oil officially in 1973. We've gone through a couple of periods where it seemed like it was, but it never went back anywhere close to that price. And the fact that it's, as I said, 2.5 times more than it was just in 2003, 2004 in today's dollars is proof of that, and it's half what it was a while ago. So we're living in a different reality, and anyone who doesn't think that that has a profound effect on everybody's business, forget about the people in this room. I'd like to have that conversation with you.
Art?
Yes.
What about the Interior Department's change under President Trump to open up all these vast acres of formerly government lands for exploration?
Good luck with that.
Well, I mean, what you're saying.
Can you repeat the question for us?
The question was, what about the Trump administration's announced plans to open up huge areas of public land for exploration? We've looked at all those areas. I mean, we looked at them in the 1970s and the 1980s. I've evaluated, I can't tell you how many hundreds of thousands of acres of National Park Service, National Petroleum Reserve, ANWR, and every time I looked at them, I came away thinking, well, what's all the excitement about here? We've drilled all that stuff off the Atlantic. I'm not saying there's no more to be found, but the perception that there's just oodles of giant fields waiting to be found out there, there's a lot of empirical evidence so far that says maybe not so much. It's not like it's undrilled country. So I'm all for opening up, anything that doesn't have a reason not to be opened up. I'm not a fan of regulation. But I think that the expectation is probably way overblown. The industry's looked at it, and there's just not, I don't think there's that much there.
So the Atlantic margin is mostly